Hello, everybody. Ben Hart here. It is Friday the 13th, September. Hope everyone's having a great week. Certainly lots still continuing to go on in the world, following interest rates and markets and central banks taking center stage over the next couple of quarters here, that's for sure. And certainly has been the case for the last 10 years. Central bankers have really been drivers of what people are paying attention to from the markets and the economy perspective. Eva is away this week, so I'll be solo again and back at it next week. I think the best way probably to go through it was just take you through some of the slides, talk to you a little bit about what I see happening. I'd say the majority of questions that I'm getting these days are around interest rates and inflation. So we'll touch on that a little bit as we go. But I think we should jump into the slides, and I'll give you some perspective on what I see and what's happening these days in the markets. So thanks so much today. And let's start off with this slide. I think it's a great place to look at things just from the perspective of what's going on from a rate view. You know, my view and our view has been that rates are going to come down, certainly materially, as we progress through time here. The Canadian economy has been struggling here as unemployment's been rising, growth's been slowing, and we really saw the Canadian Central Bank shift policy earlier this year, and they were one of the first to start to cut rates, and they've continued to do so. So when we look at this forecast, really what it's telling you here, overnight rate, that's the thing that all the central banks talk about when you're listening to what are they doing from interest rates perspective. So in Canada's case, this would be super reliant on what happens with variable rate mortgages. And so if we look at where we are today, or at least a couple of days ago, which is the same place we are today, current overnight rate in Canada is 4.25%. If you look at this little proxy below that says prime rate, the Bank of Canada would issue the overnight rate, and then the actual banks themselves would issue their prime rates, and so that's what variable rate mortgage would look like at 6.25% today. And then if you look at as we work our way down through the different tiers here, we're looking at the 2-year at 3.05%. So that'd be a 2-year fixed at roughly that plus 2, so 504. 5-year at 2.78, so you're looking at 4.78 on fixed mortgages on a 5-year. And so that's currently where we're standing today. And this is NBF put this out this week. This is their views on where we think rates go over the next multiple quarters. And so, I had a presentation earlier this week with a number of realtors just talking about what's going on with rates and markets. And so this was what we discussed at the time. So if you look at this, we're talking Q2 of next year, forecasting the overnight rate to be 2.75 versus where we are today. If you look down the page here as well, so that shows also lower rates on the 2, the 5, the 10, and the 30 as well. And so it just gives you a view at the direction that we think rates are going from here. And so I think it's important to think about it. It's not an immediate fix, but this is really a reflection of what's happening in the economy. Slowing economy, slowing inflation. So central bank's reaction function to that is to make things a little bit easier from a liquidity perspective and a monetary policy perspective. So they would be cutting rates and doing some form of QE, which is buying any outstanding bonds that are out there today. So this was a great chart, obviously busy, a bit of a Christmas tree here, but great chart from Hedgeye just around inflation. And so I think it's important just to think about the levels of inflation. Certainly we've come a long way, even from August of last year. August of last year, we had core ex food and energy, but we'll say all items CPI 367 versus where we are today at 253. And then if you look at core, we're at 320. And so this is a reflection on a number of things. But if you look at what the areas that have come down materially would be energy. Energy. We'd look at energy. We'd look a little further down the list, used cars and trucks. I'd say the only areas that are starting to see continue a little bit of higher levels would be food, home and away, And I'd say the one thing that we'd look at here is you get a bit of a green number, so it's a slowdown. So inflation continues to come down. So it's the rate of change number that matters. If it's a worse rate of change number, then it's a deflationary data. So we continue to see inflation come down. Maybe we go sideways from these levels today, but the why this chart's quite interesting is you can look at September of last year and just say, okay, what's likely to see us look the same way? You're going to get August fall off, so you're going to have some easier comparables for the next quarter. And so I think that's important to think about just when you're thinking about inflation and rates from these levels. So if we look at the US, we got Social Security Trust. And so this would be forecasting. Certainly, this is one of the major liabilities that the US is carrying right now, which is Social Security Trust. And so effectively, they have gone from saving all this money in the 80s all the way up till where we are presently. And now we're seeing a massive retirement of the baby boom. So we're starting to see these payouts start to go quickly. And so where this is a forecast that was put out. It's a great chart from Lynn Alden, who puts out excellent research always. But just the view that we could see this fall off a cliff and this would just become supported by deficit spending by the U.S. So be interesting to pay attention to because we're seeing a pivot. There's going to be material changes to currencies and countries as a result of central banks starting to cut rates. So this was an interesting piece that stood out to me, where the U.S. liabilities continue to be a major challenge from what the next 5, 10, 15, 20 years look like from a U.S. reserve currency status. So I mentioned this briefly in the daily this week was just around rate cuts and just the speed at which they've been changing recently. So we had August CPI, we saw a big bump where everything jumped back up and said there's something like a 50% chance of a rate cut coming, and then the numbers came in a little bit different than expected, so that number dropped down to kind of 50% or 15% likelihood of a cut. And then yesterday at some point midday, there seems to be some data that was leaked out about potential probability of a cut. And so within a short period of time, maybe 10, 15 minutes, we saw that probability go from 15% to 50% chance of a cut from the US Central Bank next week. So that'd be a major thing that we're looking at. Historically, when they've cut 50, that's not a great sign. We're not obviously looking for that. I think a 50 basis point cut would signify a bit of concern about the deterioration in employment and the economy. So we'll watch for that. That'll be an important piece to watch next week. But we're looking at basically a 50-50 chance of a 50 basis point rate cut next week. So we'll continue to watch that as things progress from here. So as a result of all of this conflicting information coming out, inflation, currency weakening, central banks cutting rates, a lot of different pieces that play right now, gold's got a lot of attention. And so it's continuing to move higher, hit a new all-time high. And so it's getting a lot of attention from a number of ways. Had multiple conversations with clients this week just about gold and what it means. And, is it a currency? Is it a risk asset? What is it? And so I think it plays many things to many different people. I thought this chart was good and interesting to think about. We certainly have increased our production materially, but part of the appeal, at least if you look at gold as a currency, is that you're looking at currency expands at something around 7% a year. Gold production is around growing only at a 2% growth rate per year. So actually get a positive protection of your capital by owning gold versus physical dollars. And that's where the attraction has come in for people and central banks for that matter. And so central banks have and continue to be huge buyers of gold. So this will be an important piece to watch as things progress from these levels now. So that's it on the slides for this week. And I'd say the last couple things I just want to add some comments on before we move on to what's happening next week is, there is an interesting move in stocks the last month and a half or so. We've had the utilities, some of the higher yielding stocks start to hit 52-week highs. Enbridge, TransCanada, those names have done quite well for us here, so happy to see that. But starting to think about what is around the corner from this, and if we do see this continued stimulus coming from central banks, we'll probably see the economy continue to slow. And at this point, it looks like it's all but telegraphed that the major central banks are going to continue to cut rates. Yeah, European Central Bank cut rates 25 basis points yesterday. So that's going to be quite stimulative to the economy. And so we'd be thinking about, well, when and where do we start to pivot towards taking some more risk, because bonds have helped and supported portfolios here. They've gone up. Long bond in both Canada and the US are up now year to date. Long bonds in the US are up somewhere in the neighborhood of 25% from their lows of November of last year. So I'd be thinking about, where do we pivot and where do we look to increase some risk in areas that can put the portfolios in a good shape to succeed over the next 3 to 6 months. So I would say that's it. Thinking about what and where the opportunities are and lie. So if you need anything, certainly feel free to reach out. Happy to have a discussion about what's going on in markets and portfolios, give an update on your personal situation, had planning discussions, continue to have financial planning discussions with clients thinking about retirement and what's next. So feel free to reach out to Eva or I and book something in with us, and we can go through the picture of what your financial picture is going to look like for the next 5, 10, 15, 20 years. So thanks very much for joining me. Have a great weekend. Enjoy the last few weeks of summer here that we're getting, and look forward to seeing you all next week. Thanks, everybody. Take care.